In today's video, we're going to be talking about the power of ETF funds, more specifically for Vanguard holdings, and how you can be extremely diversified with just these 4 holdings. So let's jump in. Looking at SimpliSafe here, basically I took 1 share of each of these companies at the current pricing, and just to give you guys kind of a idea of what kind of dividend yield to expect and dividend growth. So looking at the yield, we got 2.18%. That's not exceptional, but it is really solid. And dividend growth is 5.6%, which is outperforming all of my portfolios. So those are the numbers for the 4 holdings. We're going to jump into each stock and talk about what's in them, what the expense ratios are, and so on. So the first one is ticker symbol BND. It is Vanguard's total bond market. Looking at the 5-year chart, obviously they are doing really well. When the markets tend to sell off, BND does well. That's just how bonds are. They're kind of where people go to when stocks are not doing as well. So right now they are up 8.51% for the 5-year chart. If we look at the 1-year chart, they are up 6.20%. So obviously a lot of growth in the past year. Their expense ratio is 0.04, dividend yield 2.45. So that's really conservative. Bonds are a safe investment. Basically, they have 88.36% US bonds, and then they pretty much dish out the rest into non-US bonds, cash, and then convertible. Now, their annual dividends per share have kind of flatlined, but I would expect these to be raising in the current year and probably the next couple of years. So these numbers will improve a little bit. Like I said, bonds are typically a safer investment. And on top of that, this is a monthly payer. So if you're in a monthly dividend stock portfolio, like some of mine, this probably should be in your account. It's a cheap expense ratio. They pay monthly, and it is a safe investment. And it's also a really easy way to be diversified in the bond market. The next one is an S&P 500 ETF. You guys know I love SPHD. It's a monthly payer, S&P 500 ETF as well, but this is a Vanguard one. Expense ratio is only 0.03%, and the dividend yield is 1.86%. Now, the 5-year chart is what you really want to be taking a look at. They've grown 44.43%. In the past year, only 4.55%. I think for an investment like this, S&P 500 companies typically have capital gains in value. So that's kind of the play you're making here. The dividends won't be as great, but as you can see, they are consistently paying them. Looking at the allocations, they have 98.34% in US stock. As you can see down here, the top holdings are Microsoft, Apple, which makes sense. Those are the top companies in the S&P 500. So this is a good way to get in on all of those really powerful, strong companies with a price point of $290.32. If you can't afford that, obviously you want to use a platform that offers fractional shares. That way you can get in at any dollar amount and have that diversification that you're probably looking for if you're watching this video. Going over to SimpliSafe, the dividend growth for this is considered very fast at 18% in the past year. The volatility is pretty low. And as you can see, the annual dividends per share seems to just increase year after year. So those dividends are growing. The dividend yield isn't that high, but you can expect those to be increasing year after year, given the track record here shown on SimpliSafe. It is a quarterly pair, but again, you can expect those dividends to be growing. So this is kind of a longer term bet. The next one is Vanguard's REIT Index Fund, VNQ. The expense ratio is a little bit higher at 0.12%, and the dividend yield is 3.88%. Now, obviously, REITs have struggled with the virus going on, down 10.93% for the year, and we are only up 0.12% in this fund for the 5-year chart. But if you're like me and you know that the real estate markets continue to rise in general over the long term, this isn't really a concern. This will eventually recover and go well past this price point. So if you agree with that statement, then this would be a good investment for you. The REITs will recover over time. As you can see for the allocations, it's almost 100% into US companies, with the top holding being American Tower Corporation. Now, like we said, the real estate market has struggled with the virus going on, so the dividend growth has gone down 11% in the past year. But you got to take a look at the bigger picture when you are dividend investing. As you can see here, the dividends have pretty much always recovered after recessions. I mean, this is just looking at the 2008 one, but that was one of the worst ones we've had. I think this one we will obviously eventually recover, and these dividends will also increase. Over the last 10 years, it's grown an average of 5% per year, which is actually pretty good. The payment schedule is quarterly, so if you're looking for a quarterly dividend payer, this is a great real estate ETF for you. Now, the last one is VTI, Vanguard's Total Stock Market Index Fund. The expense ratio is extremely low at 0.03%, and the dividend yield is 1.83%. So basically, you want to add this one in to give you total coverage of the whole entire stock market. You could just have a portfolio with just this and replicate the returns of the stock market. As you can see on the 5-year chart, this baby is up 39.52%, and in the past year it's up 3.56%. So again, you could just have a portfolio with just this one fund, and you would basically just track how the overall market average is doing, and you would outperform most people that try to individually pick stocks. Now, 99.11% of this is in US companies, and again, the top companies are Microsoft and Apple. Those are some of the largest companies in the United States, so that makes sense. Heading over to Simply Safe, as we can see, the dividend growth is 12%, which is pretty exceptional, considered fast growth. Looking at the charts here, as you can see, year after year, this increases as the companies in the US expand and get larger. For the bigger ones at least, the dividends per share should be increasing as well. So considered very fast growth even in the past year. So this is a good addition. If you don't want it to be a huge one, you can at least use this to diversify as well and increase your annual dividend growth. So that wraps up the 4 funds: BND, VNQ, VOO, and VTI. These are just 4 of Vanguard's many funds. These are the much broader ones. They have very specific ones if you're looking for maybe just international bonds or just US bonds. They have that. So check those guys out if you want to look at more Vanguard funds. Again, this probably isn't a realistic portfolio for you, but the idea here is that maybe you add some of these, if not these ones, other Vanguard funds are just a really good option to cheaply add diversification to your portfolio. And on top of that, they typically offer pretty good dividend growth depending on the fund. So as a dividend investor, that's typically what you're looking for, is your dividends to be growing year after year, get more and more income year after year. So hopefully this video was useful to you guys. Any questions, let me know in the comments, and please like the video if you thought it was helpful. I will see you guys soon with another video.